We're on the module Pricing and Valuation of Options. And two notes before we begin. This is a very high-level introduction to some of the concepts and terminology involved with pricing and valuation of options. For those of you who know more about this than the reading provides, you may say, but this hardly scratches the surface. That's the point. It is really meant to just scratch the surface. That's it. You have much deeper dives ahead of you at level 2 in the derivative section. So don't feel that a lot is being left out. That is by design. It is just really an introduction. So you have a bit of a gift there. The second is that all options throughout this module are assumed to be European, which means last day exercise only. In this case, it's very much like a forward contract, because with a forward contract, you agree to exchange the underlying at some future price. You don't get halfway through the contract and say, okay, let's do it now. Well, sorry, but it's only done on the last day. Same with these options. It makes valuation slightly easier when you don't have to consider that they could be exercised at any time, but only on the last day. We're also going to make the assumption that the underlying has no cash flow, non-dividend paying stocks. With that in mind, let's begin. Let's look at our exercise value at expiration. And an option will have value at expiration for a call and a put under these conditions. For a call, the stock price must finish above the strike price. And for a put, the stock price must finish below the strike price. If they don't, they expire worthless. In other words, they have no value. So to have value, these conditions must be met for both the call and the put. And the loss, if it expires worthless, is equal to the premium that you paid for the option. Here I'm going to distinguish between the value of an option and the profit in an option. So let's say the stock finishes at 52 and you had a strike price of 51. That option has a value of 1. If you paid $2 for the option, you have a profit of -1. What you make net on the option has nothing to do with the value of the option. The value of the option is $1. It is worth $1. Your profit on that position can be positive or negative depending on what you paid for the option. So when we see the word value of option, we're just considering what that option would be worth at that point in time in the market for somebody who came along and said, I'll take this. What would they pay for it? Not what you made on it. That's profit. Will account for the cost of the option in this video coming up. What about exercising at any other time than expiration? So little t. So here we are. Here's an observed stock price. We know at expiration, this is the price at which the underlying will exchange hands. Well, we go back to what we learned about forward contracts. You must compare amounts at the same point in time. So you can take ST for a call. You can take whatever the stock price is and minus X and say, okay, well, that's my profit, but that's your profit over here. You would have to discount your profit back. So to make it easy, let's just leave the stock price here. Let's take the strike price and discount it back and just take the difference between the two. So for a call, remember, these are our payoffs here. So these are our values over here, which is the payoff to the option. Here is how we would calculate the exercise value at any time. It's the maximum of either 0, because the strike price might be, let's say, $60, and we observe a current stock at $40. Well, if that's a call, this will have no value. It is the current stock price minus the present value of the strike price. For a put, it is the maximum of 0 or the strike price, the present value of the strike price, minus the stock price. Okay, let's talk about the concept moneyness. And moneyness can be described with 3 different acronyms: OTM, ATM, and ITM. Out of the money, at the money, and in the money. So let's look at calls and let's look at puts. Here are our calls and here are our puts. So with a call, we know that wherever our strike price is, if the stock moves above the strike price, we start making money, we describe that as being in the money. When the stock price is above the strike price, it's in the money. When the stock price equals the strike price, it's at the money for both the call and the put. And for the call, if the stock price, this line here is ST, right? If the stock price is below the strike price, we say that it is out of the money. And it's the opposite for puts. Here's our strike price. If the stock price is above the strike price, it's out of the money because a put only has value below the strike price, right? So that would be in the money, and of course, if it equals X, it's at the money. Here it is summed up for you nicely. If you think better in terms of a stock chart, well, I've drawn out a stock chart over here, and X is our exercise price. So anything, whenever the stock price is above this line, it is in the money for calls, and it is out of the money for calls. And if it is above the strike price line, it is out of the money for puts, and down here it is in the money for puts. And every time they're equal, we say they are at the money. So if you think better in terms of a stock chart, you can just put your chart up. You can draw a straight line across your chart where your strike price is. If you have calls, you're in the money, you're out of the money, you're at the money. If you have puts, you're in the money, you're out of the money, you're at the money. Okay, let's talk about the time value of an option. On the first screen, we looked at the exercise value of an option. Now we're going to look at the time value. At expiration, nice and simple, time value equals 0 because, quite simply, there is no time. So that the value of the option C capital T, again, is the maximum of either 0 or ST minus X. We say ST because there's no time left. We are at expiration T. Prior to expiration, remember this is how we calculated the exercise value of the call or the put. For the call, it is the stock price we observe at that point in time minus the present value of the strike price. For the put is the present value of the strike price minus the stock price we observe. However, this is just its exercise value. There's more time left to exercise. There is T minus T time left. So there's going to be some extra value above the exercise value in the price of the call and in the price of the put. We call that time value. And time value, as we will see, is affected by a lot of things. It's affected by the amount of time. The longer the time, the greater the time value. The higher the volatility, the greater the time value, the higher the risk-free rate. It has an effect on the time value, opposite effect for calls and puts. We will see that as we continue on here. Time value is always greater than 0. You can never have negative time value. It's either 0 or it's something positive. It declines, we say it decays to 0 as time passes. So we'll look at this chart down here, and I'll try to make sense of it for you. Let's look at this bottom chart first, time value, and let's just assume that, let's say we have 6 months to expiration. So this period, T minus T, let's say is 6 months. And we'll draw something around the 3-month time mark, and we'll draw something around the 1-month time mark. Time value decays very fast in the last few weeks. Notice how fast time decays, or the time value decays. So in practice, what is usually done is if you say, well, look, I think a stock, trending this way, you think that over the next 3 months, it's going to get to a certain price. The temptation sometimes is to buy a 3-month call option. But the actual better thing to do is buy a 6-month call and close it out in 3 months, because look how much time value is lost in the first versus how much is lost in the last 3 months. So you can buy a 6-month option, which will cost you more, close it out in 3 months, you don't lose that much of the time value. But if you buy a 3-month option, the price has to move to compensate the full amount of the time value that you're paying for, because time has this very, very fast decay in the last few weeks. The last month, these options decay very, very quickly. Some of you out there might say, yes, that's why I sell options. You sell short-dated options because time value decays very quickly. Let's see what's going on over here. What's all this going on? Shouldn't it be the further out in time you go, the wider the possible distribution, because volatility scales with the square root of time? You have to think about it in terms of time moving this way. Let's say that this is 6 months. If you have 6 months to go, you have a certain amount of volatility in the stock that can produce prices within a very wide range. Let's say that this is 3 months to go. Well, at 3 months, volatility can produce a range of stock prices, but not as much as it would be in 6 months. And let's say at this point in time, you've got 1 week left to go. 1 week left to go at this point. Well, yeah, the stock isn't going to do this in 1 week. It's going to, within its normal range of volatility, it'll produce returns, but in a smaller range because it just hasn't got that much time. So that if you were an hour away from expiration, you wouldn't expect big moves in the stock, even though it had volatility. You would say, yeah, but volatility for the next hour is going to be so very, very, very low, because remember, it scales with the square root of time. So it would get, the distribution would get tighter and tighter and tighter until you're a few minutes away from expiration, where, well, it really isn't going to move much more than a few pennies either way. So the distribution of possibility shrinks over time. Well, if you have a lot of time and you have a wide distribution, then you have a lot of possibility that this can increase even more because you own the upside. However, after a certain amount of dropping, it's zero. It doesn't keep hurting you on the way down. It eventually gets to zero. So you pay for that extra upside. So the more time there is, the more possibility there is to add more value to the option. Okay. Pay attention here to the learning objective that we're doing. Contrast the use of arbitrage and replication concepts in pricing forward commitments and contingent claims. So what I'm going to do here is introduce the notion of arbitrage in options. Little different than you would have in forward commitments. Once we get to contingent claims, we must consider a range of non-arbitrage prices, a lower bound and an upper bound. For a commitment, there is one non-arbitrage price. So remember, our forward contract is really just our underlying 1 plus R to the T. The forward price must have this relationship with the spot price. If it doesn't, there is an arbitrage opportunity. But once we move to options, or any contingent claim for that matter, it differs because they have asymmetric payoffs. Have a look over here. Here's our strike price, and this vertical is our stock price. Well, actually, what I'll do is I'll put ST at expiration. So a call option will have value up here, calculated as ST minus X, but below X, it's just zero. It's not as if it's negative ST minus X as it would be with a forward commitment. So with a forward commitment, we have this kind of relationship. You have a symmetric relationship, but with the call option, you have this. So arbitrage pricing can't refer to just one single price period and that's it. It exists within a range. So the best we can do when it comes to contingent claims and say there is an arbitrage opportunity if the call is above its upper bound or below its lower bound. In between the two, who knows? Look at the put. The put down here is X minus ST, but up here it is zero. It is not as if it's negative X minus ST. So because of this, we have these ranges we'll get to down here, the lower bound and the upper bound. For now, let's before we get there, let's introduce the notion of profit on the call, profit on the put that we talked about earlier. This is the exercise value at expiration of an option minus whatever the cost is. So the first term is your exercise value. There's your cost. That gets you your profit. Here's your exercise value. Here's your cost. That gets you your profit. And you can substitute exercise value for exercise value at any time other than expiration minus the put to determine what your profit would be at that point in time. But because they're European options, it really is just a quick measure of your profitability in that position at that time. You must wait till expiration before you can actually exercise. All right, let's talk about upper bounds and lower bounds. And it's probably easier to talk about the upper bound first. So this is the value of a call at any point in time. This is the value of the put at any point in time. The value of the call must be less than or equal to the stock price. It would have to be, because if it were greater than the stock price, just buy the stock. So imagine a call, not imagine a call. Let's think about the stock price. A stock price is really just an option with an exercise price of 0. So if you own the stock at any point in time, it is the same as having an option that has no expiration date with an exercise price of 0. Let's say you saw a stock for $25 and you were going to buy a very, very deep in the money call. Well, let's say that there was a call with a strike price of 0 and you bought that call. You'd never pay more than $25 for it because you could just buy the stock for the $25. So the stock price itself sets an upper bound on the call price, that the call will always be less than or at best equal to the strike price. Equal to the stock price, but you can sort of take off that equal sign. I've never seen a stock price and an option price be equal in price, because there are no such things as options with a strike price of 0. The lowest you could probably get, even if they had $1 increments, is $1 if they went that low on a $25 stock. You're not going to pay more than $25 for that, because you would just argue, why would I pay $25.50 for a call when the stock's only $25? It's the cheaper way to go. So we have an upper bound. The upper bound is the strike price. So for this one, let's just erase this, and we will write something else in here for the put. Let's say you have a stock at $50 and you're going to buy a strike at $40. And you want to buy the put at $40. That gives you all the profitability down to 0. And let's say the price was $41.50. Well, you would never pay $41.50 for the potential to make $40, right? So we can say that the upper value of the put would be X, less than or equal to X. And again, you can get rid of the equal sign, because if they were equal, you would say, why would I spend $40 just for the possibility of making $40? No one would ever do it, so the option would never get bid to that price to begin with. And what is our lower bound? Our lower bound is our exercise value. It can't be cheaper than our exercise value, because if it is, then you have an arbitrage opportunity. So somewhere between the lower bound and the upper bound is where the value of the call lies, and somewhere between the lower bound and the upper bound is where the value of the put lies. Now we can use a pricing model to determine what the call and the put would be on a fair value basis, but that assumes a certain level of volatility that we would expect to see going forward, and that's priced into the option. Typically, the call and the put can range anywhere in between this amount, and we would not say there's an arbitrage opportunity. We would just simply say the volatility assumption used to calculate fair value must be wrong. So we have a concept called implied volatility. So when we look at the pricing of a call, if it's in between these two bounds, it is fairly valued. In other words, it is a no arbitrage price, and its price reflects some implied volatility that the market believes is going to happen on a going forward basis. Okay, let's see how the notion of replication applies to options. For a forward, we know how to replicate a forward contract. A long forward contract can be replicated by borrowing money, buying the underlying, waiting to some point in the future, whatever the expiration of the contract would have been that we're trying to replicate, selling the underlying and using the proceeds to pay off the loan. Either you're going to have a profit or you're going to have a loss, the same profit or loss you would have on the forward contract, because the forward contract is the spot price carried at the rate of interest. So would your loan be, right? Well, with options, little bit different here. Let's say we see a call option with a delta of 40. This is just an example, okay? And we're going to do the same thing with a put with a delta of 40. This is just an example. The delta is the measure of the change in the call price for a change in the stock price. That's all it is. So that if the stock price goes up $1 and an option has a delta of 0.4, that means the option would go up in value by 40 cents. That's all that is just a rate of change in the price of the call, or the rate of change in the price of the option for a change in the stock. I shouldn't say the rate of change, but the change in the value of the option for a change in the value of a stock. So if it has a delta of 0.4 and the stock goes up $1, the call option will only go up 40 cents. How do we replicate 40 cents? Well, we'll borrow 0.4 amount of the expiration value, the present value of the exercise price, We'll borrow 0.4 of the exercise price and we'll buy 0.4 shares of the underlying. So if we only had 0.4 shares and the share went up $1, well, this would only go up 40 cents. So that is how we would replicate a call option using borrowing and buying the underlying. For the put, we would short sell 0.4 shares of the underlying, and then we would lend 0.4 times whatever the present value of the strike price happens to be. Now, if we did this with a forward, let's say that we're going to buy the underlying, we're going to borrow money to buy the underlying, and we're going to borrow money to get that done. We will know at some future how much we owe on the loan. We just don't know what the future price of the underlying will be, but we'll know how much we owe on the loan. Once we do this, it's set once. You set it once, and you forget about it until this point in time. Well, with options, it's not a set once and forget about it. It is a set today and modify tomorrow and the next day and the next day, because as the stock price changes, it will change the delta. So if the stock price goes up $1, we would expect the call to go up 40 cents, but the new delta might be 0.42. Well, now we are not replicated. So we would have to borrow another 0.02 of the present value of the strike price and buy another 0.02 shares of the underlying, so that we now have 0.42 shares of the underlying. And we would have to keep adjusting every day to replicate what a call option would do. That's as deep as we go. I just want you to get the difference between the option and the forward. For the forward, we can buy the underlying with borrowed money. We can set it once and forget about it. We do the same thing if we're trying to replicate the call. We borrow a certain percentage of the money, because we can't borrow the full amount now. We have to buy a certain percentage, and we buy a certain percentage of the underlying. That's on day one, and then we must adjust it every day or every second day or every third day. Adjusting every day might be too expensive, but if you wait every 3 days or every 2 days and you readjust, you realign your delta, then you can replicate the call over time. So it is a lot of work to get that done, and the put is the opposite. You're just short selling first and then lending the money. More of this at level 2. You're going to see a lot more of this at level 2. Who does this? You may say, who would do this? These are dealers. Dealers that make a market in options, they'll sell calls and they'll sell puts, and they have to hedge it out. Well, how are they going to hedge it out? Because they can't just set it once. It's not very simple to hedge out. So they have to delta hedge every day, and this is how they do it. Okay, let's go on to the next learning objective here. Identify the factors that determine the value of an option and describe how each factor affects the value of an option. The biggest one by far is the underlying, is which way the underlying stock is moving. That is the biggest one by far. Delta is your dominant factor affecting the price of an option. Remember, delta is the change in the value of an option for a change in the value of the stock. So here's a stock chart. I think people think better with stock charts. And here is a stock price that is rising. And when you have something like this, all call values are rising, all put values are decreasing, regardless of where your strike price is. If the underlying is moving up, all call values are increasing, all put values will be decreasing. And as the stock price is going down, all call values will be decreasing, all put values will be increasing. And the magnitude of the change at any price is approximated by its delta. So for any option, let's just take options. Let's say we have puts at 50, 45, 40, and 35. And the stock, let's say, is also at 50. You'll have a delta roughly equal to 0.5, meaning if we looked at a distribution of possible returns, the distribution of returns at $50, I'll just draw it right here, would look like this, which means you have 50% chance it'll go up, 50% chance it'll go down. So that delta, that 0.5 is, you can think of it as a probability that the price will move that way. A 45 will have a delta less than 0.5 because there's 45, we're at 50, there's 40, and if you extend the distribution out, there's 35. And we're looking for the probability from this way onwards, right? So the 45 might have a delta of, let's say, 0.4. Might only be 40% probability of the price going below that. A $40 stock might have a delta of 0.3. A 35 might even have a delta as low as 0.1. So that if the stock dropped $1, the $50 put with a delta of 0.5 would increase by 50 cents. The 45 strike price with a delta of 0.4 would increase 40 cents. This $40 strike price with a delta of 0.3 would increase 30 cents, and the $35 put would increase by 10 cents. So they don't all increase by the same increment. They all have different deltas. The big takeaway here is as the price is moving down, all puts will increase in price, and all calls will decrease in price by in proportion or approximation of their delta. Okay, two more factors, the exercise price and the time to expiration, and I tried to put them all on one payoff diagram so that you can see them. These dotted lines, here is the legend for what these are. The blue ones would be 3 months to expiration. The green dotted lines is an option with 2 months to expiration, and the white one is 1 month to expiration, and the red is at expiration. So let's repeat something from the previous screen. For calls, we know that the higher the underlying price goes, the higher the option value, and the higher the delta of the option. And you can measure the delta of the option by taking the slope. See these little convex lines? Options have convexity, right? If you take the slope of the line at any point in time, the slope is its delta. Notice down here that it's almost a straight line. The delta would be very close to zero. The slope would be close to zero. But here you have a very steep slope, so the slope would be higher, closer to 1, a 1-for-1 move with the underlying. And for puts, we saw on the previous screen, the lower the stock price goes, the higher the option value for puts, and the higher the delta. This is convex in just the opposite way. Now, how does the exercise price determine the value of the option? Well, let's imagine we're right here, ST, and here's our strike price, and depending on how much time we have left, we can just keep going up and we can see what the value of the option would be. Well, imagine that the strike price was lower. Well, the option would have higher value because the distance between ST minus X would be greater. Now imagine if the strike price were over here. Instead, would be somewhere down here in this particular diagram if the strike price were over here, because it would only be going up at that point in time like that. Same with the put. If you move the strike price down further, the option would have less value. If you move the strike price up closer towards where the stock price is, the option would then have more value. So if we take an option that is at the money, and we decide, well, instead of using an at the money option, let's use an in the money option. If it's in the money, it will already have more value. If we move it further and further out of the money, the value of the option will drop further and further and further. So depending on where you select your strike price will determine how much that option is initially worth. Now let's talk about time to expiration. And we'll use the put here and the call here. We'll use these two diagrams to look at it. Let's say we're looking at an at-the-money option, an at-the-money call, and an at-the-money put option for both of these. The red line is at expiration. This is the payoff at expiration. All the others are at particular points in time, and they're convex. The closer you get to expiration, the closer the convexity gets to this particular type of payoff, the red line here. So if we're at the money, at expiration, the option clearly has no value. However, if there's 1 month left, the option has a certain amount of value. If there is 2 months left, the option will have higher value. And if there is 3 months left, the option has even more value because there's time for the option to perform. If there's time for the option to perform, you'll pay for that in the time value. So the more time you have to expiration, the more convexity that you will get out of this option, the higher the value of the option will be. We see the same thing here with 1 month. Here is the price of the call, or the value of the call at that point in time. At 2 months, we can see the value of the call. I'll put a 1, I'll put a 2 here. And at 3 months, you could see the value of the call at 3 months. The more time we have to expiration, the higher the value of all options will be for any given strike price. So if we look at a stock that's at $40 and we look at a $45 strike, and you look at it over time, you look at the January, February, March, April, May, June, January, February, March, April, May, June, and we're just looking at value, this is CT, of that particular strike price, you will get something that looks like this. You will get an upward sloping line because the value of the option increases the more time that you have. Okay, fourth factor, the risk-free interest rate. This will have an effect on the value of calls and the value of puts. An increase in the risk-free interest rate leads to an increase in call prices and a decrease in put prices. And of course, if you reverse it, you reverse this relationship as well. So that you can see that this is true, let's look at exercise value for calls and exercise value for puts. Here's our exercise value. Notice that if we have a higher R over here, we'll have a lower second term, because if you have a higher R, you'll have a higher denominator. X is fixed, which means the second term gets lower. Since it's ST minus a lower second term, you will have a higher call value. As R increases, the distance between these two increase, the value of the call increases. For the put, if you have a higher interest rate here, you will have a lower first term. If you have a lower first term minus ST, the difference between this decreases, you will have a lower put price. And you just reverse that for a drop in the interest rate. Let's look at volatility. Volatility, you will have higher put and call values. If you prefer the word premium, we can use the word premium, higher call and put premiums. A premium is the same as the value of the option. Reason is, let's look at the chart that we have here. Notice we have one distribution which is narrow. We increased volatility. We have a wider distribution on both sides. It affects the potential upside value of a call. We'll get to puts in a second. If we're just thinking about calls, it affects the potential upside value of a call without affecting the downside. It doesn't affect the downside because the downside is bounded by 0. Either it's going to have some value or it'll have 0. Because it's asymmetric, right? So we get extra potential on the upside without being punished more on the downside. So that clearly has more value. If we can get more upside potential but no difference in our downside, that obviously has value. It's the same logic for a put, except you would just change the arrow this way and you would say, well, we have more potential for downside activity in the price of the underlying without being affected if it goes up because we're bounded by 0. And finally, income and costs. If the underlying has dividends, it will decrease the value of the call and it will increase the value of the put. An easy way to see that is I want you to think about a stock that goes ex-dividend. When it goes ex-dividend, the price opens up the next day by the amount of the dividend, and then it has to climb. So if you have a call with a strike price of X, and there's going to be a dividend before the expiration date, let's say that your expiration date is over here, well, that means that the stock price has to climb up to the strike price. There's going to be a dividend, it's going to drop, it's got to reclimb back up what the amount of the dividend was to get above the strike price. So a stock that pays dividends, especially a stock that pays dividends often like monthly and they're big dividends, it's going to have it has to overcome all of those dividends on the price to get above the strike price. Clearly it's going to put downward pressure on the value of the call, but it's moving in the direction of the put. So the put value increases. If there are costs associated with the underlying. Now when we think about costs with the underlying, you may be thinking, but stocks, equities have no cost to hold them. They're costless. And you're right. If the underlying is an equity, we don't have to worry about costs. Either it pays a dividend or it doesn't pay a dividend, and that's all we need to know. However, you can get options on futures. And futures have an underlying, and that underlying may have costs associated with it. So that will flow through to the option. So costs will increase the call value and decrease the put value, much like it does when we calculate a forward price. Remember, to get a forward price, it is the stock price, and we would subtract the present value of any income. There is the call value going down, and we would add the present value of any costs. There is the call value going up. And since this makes the forward price higher, it's got to make the put value cheaper. That's it.